if you look at how this normally plays out in emerging markets, it can just go on for a very long time. Like look at Argentina. How long have they had serious inflation, right?
Hmm.
It's just year after year after year. Yep, it's still a problem. Yep, politicians still don't know what to do about it. Yep, it's still a problem. And I think basically what we're going to see in the U.S. is kind of a low grade version of that. Basically, a developed market with emerging market characteristics around the
Hmm.
margins, which is to say, structurally big deficit, no appetite among politicians to be able to fix it, high levels of polarization to even figure out how they would fix it. And then what makes it even harder is that should they somehow fix it, let's say somehow next week both parties get together and say, okay, we're going to raise this tax, we're going to cut this spending, and we're going to do this, and we're going to get the deficit down to like, 2% of GDP instead of 6% of GDP. If they were to do that, the problem is that the US tax receipts are more financialized than most other countries, meaning that if stock prices go down in Europe, it doesn't affect European government finances as much. Whereas if stock prices go down or even just sideways for a while in the U.S., our tax receipts start to suffer.
Hmm.
It's a couple reasons. One, we have more wealth concentration, and two, a lot of our CEO and executive compensation is
Yeah.
very much tied to the equity and options and things like that, basically the performance. And so you can have a situation where you could try to do austerity, but then ironically hurt your tax receipts and potentially keep the deficit as wide or similarly wide while also having a slower economy. So nothing short of a very significant overhaul would basically stop the train, and probably after a pretty material currency devaluation as well. I don't think that's been another level. The way I would kind of phrase it is that things can break, but sometimes that thing that breaks is not very dramatic because it's kind of like a plumbing issue that gets fixed right away. Probably the best example is the repo rate spike of September 2019, right? That was one of those things that everybody who's like focused on macro freaked out, and technically, if left unaddressed, that would be a catastrophic problem. But it didn't. It wasn't actually. It wasn't like banks were going down. It wasn't like, we were having some big noticeable thing for anybody outside of finance. It was this little like micro break that was fixed, within a 24-hour period, thanks to money printer go burr. And we just kind of mildly then, things started to do well. Asset prices went up until, of course, we ran into COVID. Um,
Hmm.
and so I kind of see a similar thing like that, where we get some mild breakage somewhere, and then that's the Fed's signal to kind of go back to balance sheet expansion. And the funny thing is, the New York Fed is basically expecting that, right? So in their annual report, they look out and they kind of look at, let's say, by the end of 2025, they probably expect to go back to balance sheet increases. Um, and so they would not phrase that as QE, because in their model, and of course things could change based on if we get a recession or something, maybe, but in their model, basically recession aside, they would go, this quantitative tightening, they eventually would run out of the reverse repo facility, and any sort of further tightening would eat into bank reserves. And they want to maintain what they call an ample bank reserve environment. And so once you get down to a certain level, you get something akin to like that repo spike, or you could technically try to stop right before something like that happens, or just use something like that as a signal. And then when they do go back to balance sheet growth, it doesn't necessarily mean like what we saw in March 2020. It doesn't mean, balance sheet goes straight up, but their target is to grow the balance sheet in such a way that it's a constant percent of GDP. That's kind of like their back of the envelope expectation of what they're expecting. And if we don't get a crisis, if we don't get a recession, that would be my base case as well. I think their math is fairly accurate in that sense. But then we go back to an environment of the monetary base kind of gradually going up, very large deficits that are being partially accommodated by the Fed there. They wouldn't phrase it like that, but that's what they'd be doing as long as they're structurally increasing their holdings of treasuries. In
Hmm.
addition, they also specifically view themselves as continuing to sell off their mortgage-backed securities while going back to treasury purchases. So their balance sheet rotates more toward funding the government and less toward funding, homeowners essentially.
Hmm.
Um, and so that's kind of, even they are basically calling for that. And I think that's directionally correct. So I think it's possible, but I generally would fade the more severe ones. So some of the payroll data is unclear. There's different ways of measuring payroll, and they're kind of conflicting with each other. There are other ones that don't really get subject to revision, like for example, jobless claim filing. That's not
Mhm.
really an estimate. That's just an account of things that happened, and that doesn't look particularly recessionary,
Mhm.
other than maybe really early stage recession. Technically, it's possible. We did have kind of a technical recession some years back when we had two negative quarters in a row of GDP shrinking. That's not how kind of the official recession is declared, but that's kind of like a rule of thumb that people turn to, and that's because we were kind of coming down from sort of stimulus highs. So
Mhm.
we had like kind of rotating soft patches. Basically, we've had a manufacturing recession, we have a commercial real estate recession, but we have a travel boom, and we have a services holding up pretty well also. So there's like pockets of the economy that are in a recession, but those don't seem to be enough yet to have us in a full recession. But I wouldn't be shocked if, say, we look back 6 months from now and it turns out this was kind of like early stage recession. But one of the kind of the cycles I'm using as a kind of a guidepost is the 2000s decade, kind of like the 2002 to 2007 period, because after the dot-com bubble, we had what was effectively a very mild recession. It was more mild than the ones that came before it. It was more mild than the ones that came after it, kind of in kind of both directions. So it's a mild recession, obviously a big drop in stock prices. The Fed cut interest rates, and things just kind of carried on from there. So the only thing I would really overlay on top of that is the fiscal situation that we basically would
Mhm.
be in a similar environment, but with more overall fiscal stimulus, which is one of the factors why I point toward a mild recession if we get one, and potentially one with somewhat more stagflationary characteristics, or at least less disinflationary characteristics than you normally get in a recession, because you have that kind of constant background stimulus while you're potentially going through it. I certainly think that parts of the market could. For example, if you get say a Trump victory, all else being equal, that administration is probably more accommodative for Bitcoin and the broader crypto space, and they're probably more accommodative for other sectors that are generally more in that camp. If you get a Harris win, probably not as constructive toward Bitcoin and crypto, but instead you might get something more kind of green related, or things like that. You might get more tightness on energy production, even though the current administration actually has not been very tight on energy production because they didn't want to exacerbate inflation, which is funny because like when Biden campaigned, he was rather anti domestic oil production, but didn't really follow through with that, which I think is a good thing. But it's just kind of so I kind of
Mhm.
expect her to probably do a similar approach, because if you do kind of cut down on domestic oil and gas production, you're probably going to exacerbate inflation risks. Um, so around the margins, obviously elections matter, and then outside of economics, they matter. There's a whole other things like social things that don't really apply to investments that I just don't really like. It's just a different bucket of things. So it's not to say that elections don't matter, but it's to say that none of my kind of structural forecasts or expectations for the economy would be materially changed based on the election outcome. I think he knows the momentum of where things are going. So I don't think he personally has a big reason to be against it. It doesn't mean he'll necessarily go. He might not do all of his campaign promises that he made, but I think it's less likely he would turn hostile on it at this point. It's possible. Anything is possible. I don't think you should ever kind of trust a politician. They're all like on both sides right now. They're in their pandering election
Yeah.
campaigning environment now. One thing I did point out, like, to your point, is that even though a lot of the headline speakers were from the right side of the political spectrum, there were a number of politicians there from the left side of the political spectrum. And during the conference, a bunch of them even wrote to the DNC and
Yeah.
said, like, this party has to kind of get up to speed on this a little bit better, because this is not like the right way of doing things. It's putting votes and fundraising and things like that at risk. And the reason that's important is because when you think of like major tail risks that could really impair or otherwise disrupt Bitcoin adoption, one of them would be a very hostile U.S. government. And even if
Hmm.
it's not, even if it's not bad enough for Bitcoin, it's still bad enough for American Bitcoiners. As American Bitcoiners, that that we can be pressured and we can have issues against us. We obviously don't want a hostile environment. And so when we look back at, for example, when they banned gold in the 1930s, people often bring that example up as though like, oh, as though the government's a monolith and can just decide to do things. Whereas back then they had a super majority, right? They
Hmm.
basically, there was such a kind of a collectivist concentration of power at once that they were able to do rather extreme things by American standards. Whereas in the current environment, as long as there's kind of enough political pressure that there's not any sort of supermajority against Bitcoin, then it's at least somewhat shielded from some of the kind of the worst outcomes. If you have, say, a majority of Republican lawmakers are either kind of neutral or for it, and then you have minority of Democratic lawmakers that are kind of neutral or for it, then it's hard to do any sort of like really anti-Bitcoin draconian type of legislation. And there's more levers to kind of push back on should they attempt it. So I think that's why that at least some degree of bipartisanship is relevant to be aware of and to promote.